You've probably heard the phrase eat the rich, right? It's everywhere. But what if we actually looked past the shock value and dug into the math behind it? Well, in this explainer, that's exactly what we're going to do. We're digging into 40 years of economic data and the theories that have fueled this exact sentiment.
So, to set the stage, one of our sources kicks things off with this very formal, almost classical sounding observation. It says our current economic situation isn't just a small problem, it's a most vexing predicament. This language is very deliberate, and it's setting us up for a pretty radical idea.
And there it is. Now, obviously, this is satire, but it's really powerful satire, and it forces us to ask the real question we're here to explore. What kind of economic conditions, what data, what history could possibly lead to this level of dark, frustrated humor? Let's unpack it. So that satirical proposal, it's not the main course here. Think of it more as the frame around a much bigger picture. It's the entry point for understanding a really deep economic story. A story about a single, powerful theory that has shaped the entire global economy for the last 40 years. Okay, so let's pivot to the theory at the absolute heart of this whole debate, supply-side economics. You might know it by its famous nickname, voodoo economics, which, funnily enough, was a name given to it by the very politician who would later become its biggest champion. So, what was the promise? Well, the idea itself was pretty simple and, you have to admit, pretty compelling. Cut taxes on corporations and the wealthiest people. The theory was they'll take that extra money and invest it. Build new factories, create new jobs, and all that new prosperity would eventually trickle down to the rest of us. That was the hypothesis, anyway. And here, well, here's the 40-year report card, according to the data and the sources. It compares the promises with the outcomes. The theory claimed tax cuts would pay for themselves through growth. The reality? The national debt absolutely exploded. It promised that wealth would trickle down to create jobs, but instead, the share of the entire economic pie going to workers actually went down. Okay, so that was the theory, but what about the proof? Let's look at the hard numbers from what has basically been a massive 4-decade-long economic experiment. To really see the contrast, the sources tell us to just look at America's own history. Back in the post-war era, from 1950 to 1980, top tax rates were way higher. We're talking 70, even up to 91%. And during that time, the economy actually grew faster. Not only that, but the gains from that growth were shared much more broadly. Then, after the big tax cuts in the 80s, you see two things. Economic growth slowed down, and the top 1% started capturing about half of all new income. 350 to 1. Just let that number hang there for a second. What does it mean? Well, in 2023, that was the average pay ratio between a CEO and their median worker. And this chart, wow, it really puts that number into stunning perspective, doesn't it? The data shows that back in the 1970s, the ratio was around 20 to 1. The visual jump you see here, from that small bar to the giant one, it's a really powerful way to see just how dramatically the distribution of economic gains has shifted over the last few decades. So, this all brings up a really important question. How did this happen? Was it just an accident? Well, the sources we're looking at argue no. They point to very specific structural policy changes that created what they call the architecture of today's economy. This timeline shows a few of those key architectural moments. You have the major tax cuts in '81 and again in 2017, which really changed the rules of the game. But look at what's sandwiched right in the middle. A Supreme Court decision that, according to this analysis, completely rewired the connection between money and politics. The Citizens United decision basically said that money is a form of free speech, and that just blew the doors off of limits on corporate spending in elections. The sources argued this created a powerful feedback loop. A ton of wealth is used to get favorable policies and regulations passed, which in turn helps generate even more wealth, which can then buy even more political influence. So where did all that extra money from tax cuts go? If it wasn't building new factories, what was it doing? The sources say it poured into something called financial engineering. Things like share buybacks. That's when a company uses its own cash, trillions of dollars worth, not for R&D or higher wages, but just to buy its own stock to pump up the price. Or into derivatives, which are basically just complex financial bets that have created a market 8 times bigger than the entire world's economy. The argument here is that these tools are designed to extract value from the system, not to create new value within it.
All right, we've looked at the theory, we've gone through the data, we've even examined the architecture. Now let's try to put all the pieces together and connect it all back to that satirical dissent that got us started. This quote here from Dr. Masood Raha really just crystallizes the core reason why that trickle-down promise didn't pan out, according to this analysis. In today's globalized world, capital is speculative. It can jump from country to country in a millisecond, chasing the best return. It doesn't have to build a factory in your hometown anymore. As he puts it, the money just makes more money all by itself, without creating widespread prosperity along the way. One of the sources introduces this really fascinating mental tool from the famous investor Charlie Munger. It's called inversion. So instead of asking, how do we build a fair and healthy economy? You flip it. You ask the opposite. How would I design a system to guarantee failure for most people and concentrate as much wealth as possible at the top? The unsettling conclusion from the source is that the system you design, well, it would look a lot like the one we have now. And that brings us completely full circle. That satirical rage from the opening quote starts to make a different kind of sense now, doesn't it? It's not being presented as a serious policy solution, of course, but as a predictable cultural symptom. It's the kind of dark humor that bubbles to the surface when, according to this analysis, a huge number of people start to feel like the system's incentives just aren't aligned with their well-being anymore. So we'll end with the big question that our sources really want us to think about. When the data shows decades of things moving in one direction, and the culture responds with gallows humor, what does that really tell us about the health of the system itself? That's the thought we'll leave you with. Thanks for joining us for this explainer.